So, what happens when a company gets the call up to the big leagues of the stock market? I'm talking about getting that coveted invitation to join the S&P 500. You know, it's way more than just a pat on the back. It kicks off this really fascinating and honestly often misunderstood financial event called the index effect. And today, we're going to pull it apart and see exactly how it works. All right, let's start with a little mystery. Picture this. You've got a well-known company, everyone's following it, the stock is just kind of chugging along, pretty stable, and then boom, seemingly overnight, the price just skyrockets. There's no new product, no crazy earnings report, so what on earth is going on? And hey, this isn't just some hypothetical question. Take a look at what happened with Palantir Technologies. One day, the stock is doing its thing, business as usual. The next, right after a certain announcement, you see this sharp, undeniable jump straight up. This is the exact phenomenon we're going to deconstruct today. Okay, here's our game plan. We'll start with that mysterious price pop. Then we're going to peek inside the very exclusive S&P 500 club. After that, we'll get into the mechanics of the index effect itself, ask if it's really a golden ticket for long-term success, and finally, we'll explore whether this whole effect might be starting to fade away.
So, first up, the mysterious price pop. We saw the chart, right? Now let's dig into the why behind Palantir's sudden change in fortune.
And the answer is, well, it's surprisingly simple. The trigger for that massive surge was just a single piece of news. Palantir was going to be added to the S&P 500 index. That's it. No new information about the business, just an invitation to the club. But what is this club, and how does just getting an invite cause such a huge stir? Which brings us right to our next section, inside the S&P 500 club. Now, you'd probably think getting into an index this important is all done by computer, right? Just pure numbers. But it's actually a little more interesting than that. On the surface, yeah, there's a clear checklist. As you can see here, they look at things like a company's market value, how easily its shares trade, where it's based, its financial health. You get the picture. It seems very objective, very black and white. But here's the kicker. This quote from ResearchGate points out something crucial. A company doesn't actually have to check every single box. The final decision is made by a committee, and it's up to their discretion. This brings in a human element, a subjective factor, which is exactly why these announcements can still be such a big surprise. Okay, so a surprise announcement is made. A company is in. But how does that news translate into a massive stock price jump? This brings us to the real heart of our explainer today, the index effect.
So, what is it? Well, simply put, the index effect is the name we give to this exact thing. A stock's price tends to pop right after it's announced as a new member of a big index. But it's not magic, you guys. It's all about market mechanics.
Here's how it unfolds. It all starts with that announcement, and instantly, a huge wave of what's called forced buying begins. Think about it. Thousands of index funds and ETFs that are designed to perfectly mirror the S&P 500 are now required to buy that new stock. It's not a choice for them. Their whole reason for existing is to track the index. This creates a sudden, massive spike in demand. And basic economics tells us what happens next. When demand shoots through the roof, the price gets pushed way up. The key thing to remember is this has nothing to do with how people feel about the company. It's a purely mechanical effect baked into the market structure.
Now, this all sounds amazing for the company, doesn't it? It feels like getting into the S&P 500 is a golden ticket to guaranteed success. But is that actually true? Let's break down the myth versus the reality here.
So the myth, the thing everyone seems to believe, is that this is a permanent seal of approval, that the company is now set to outperform for years. But the hard data? It tells a totally different story. Research consistently shows that after that initial pop dies down, there are no significant abnormal returns over the long haul. That price jump is really just a short-term frenzy, driven by those buying mechanics we just talked about, not because the company's business suddenly got better.
And this chart really tells the whole story, doesn't it? Over decades, what actually drives long-term returns are the fundamentals: earnings, innovation, real business growth. These short-term events like index inclusion, they're basically just blips on the radar. The market always finds its way back to what truly matters.
All right, for our last section, we've got to ask a pretty fascinating question. We figured out what the index effect is, but what if the effect itself is getting weaker? What if the magic is starting to disappear?
And we're not just pulling this out of thin air. This quote from smartasset.com really hits the nail on the head. More and more analysis suggests that this once super powerful price pop just isn't what it used to be. The effect seems to be shrinking, sometimes to the point where you can barely even notice it.
So, why is it fading? Well, in a word, efficiency.
Today's markets are just flooded with data. Traders are using incredibly sophisticated tools to predict which companies are the most likely candidates for inclusion. They are essentially trying to front-run the committee, buying up shares in these companies before any official announcement is ever made. The element of surprise is vanishing, and when it goes, it takes that big, dramatic price pop with. And this leaves us with a fascinating real-time experiment. Just look at a company like SoFi. By early 2026, it seems to have cleared all the major hurdles for S&P 500 inclusion. We're talking a huge market cap and sustained profitability. The whole market knows it's a prime candidate, so the big question is, has the price pop already been priced in? Or will the sheer scale of that forced buying, we're talking an estimated $15 to $20 billion from index funds, still trigger a massive surge? We might be watching a former retail favorite literally transform into an institutional core holding right before our very eyes. It is a live test of whether our markets have finally outsmarted one of their oldest tricks. What do you think?